I'm Amy, Head of Learning and Development and Support at Trade Shield. Welcome to a 2026 edition of what we are going to be offering you at Trade Shield. And hopefully you've seen our mailers, which our marketing team have been putting together. So they look a lot better than the ones I did. But very, very exciting that we're going to be offering 2 sessions a week. Last year, we really struggled to jam pack everything that we wanted to offer you into one Thursday session. So what we're going to be doing now is every Tuesday, we have a session on Trade Shield specific. So if you would like to join the Trade Shield specific training, where we're going to be covering the actual platform, how to use it, understand it, and that would be the time for that. And then every Thursday, we will be focusing on credit, the credit industry, and things that affect the industry as well. So it's not just necessarily only about how to be a better credit manager, a better credit controller, a better CFO, a better salesperson, but also what's happening in the industry around us. What are things that we need to take into consideration? What laws are coming into play that we need to ensure that we're up to date with? So that's what we're going to be focusing on the Thursday sessions. And we're starting the year off with a very exciting session, and not only because he's my boss, but I have the privilege of welcoming Rahil, our COO here at Trade Shield. And then for those who have not yet met Martin, Martin is our head credit executive with years of experience in the credit industry. And he will then obviously be lending his knowledge and experience with us as well. So without further ado, let's start off with Accounting 101, the basics that we would need to know in order to understand what are we doing, what is the industry that we're in, and how does this affect us. So thank you, Rahil, and take it away.
Thank you to Amy, and thank you to all of our esteemed colleagues and guests that have attended. First one for the year. I always excited to join these. Always feel very passionate, and always feel like I need to show up. So hopefully we can have a good session with everyone, and we can go through some of the the important things that you can see in financials. So today is called Affordability and Risk in Financials. So just by way of introduction, thank you for the introduction, Amy. My name is Rahil. I don't say this too loudly in public very often, but I'm an accountant, and so the numbers have always appealed to me, and hence, even when we've moved in, especially in the credit fraternity, you cannot forget the numbers. The numbers are important, and the numbers tell a story. They don't tell the only story, but they do tell a story. So let's get right into it. So what do we want to do in today's session? What are we going to look at? Well, we're going to be talking about the importance of understanding audited financial statements. So what are the key agenda? So we're going to look at what are the key financial statements. There's 3 of them that are the important ones that we're going to look at. We're going to look at some important ratios and metrics, what to look out for in these financial statements, and what are some of the key indicators that you can look at. We're going to see how you can use financials to assess affordability. And lastly, we're going to identify some risk factors in the financial statements that you do, that we're going to be going through. So without further ado, so what are the key financial statements? When people talk about financial statements, there's a whole pack that you'd get, especially when you're looking at a listed company, the integrated financials. It could be 100 pages long, but in all of those 120 odd pages, there are 3 important pages that you would come across, which are the 3 that I'm going to go through shortly. So the first one is, I'm using some of the old school terminology. It's the balance sheet, okay? Or as it's called now, the statement of financial position. And what is your balance sheet? Well, very simply, it's a snapshot of your financial position at a point in time. And it includes some key components such as your assets, your liabilities, and your equity. If I were to equate that to something in our everyday lives, your balance sheet would be, what does your bank account look like at the end of the month on the 31st of January? That is your snapshot of your financial position. How much do I have in my account? How much do I owe on my car? how much do I owe on my bond. That is, in essence, what the balance sheet is. We then have the income statement, or as it's called, the statement of comprehensive income. And this basically speaks to financial performance over a period of time. Now, it's usually 12 months when looking at financial statements. And what are your key components here? It's your revenue, it's your expenses, it's your net income or your loss. Looking at that, in essence, would be our budget as an individual. If you put together a budget, right at the top of budget, you've got your salaries, then you've got all of your expenses, and right at the bottom is how much do I have left over after all of my expenses from my salary. That is, in essence, what the income statement of a company is. And lastly, the cash flow statement is how does cash flow in and out of a business, and that could be through operating means, so i.e. selling goods and purchasing goods, investing, you investing in maybe in other divisions or in other business units, and financing activities. What loans am I granting or am I receiving? And those are your three, that's the most important stuff from your cash flow statement. So in essence is, how has my cash moved from period to period? Now, those are your three important financial statements that we're going to be covering. So what are the important things in these financial statements? Well, let's go through some of these in a little bit more detail. The things that you can get out of your financial ratios and metrics that are important is there's certain ratios that you can identify. So you get liquidity ratios. Okay, so what is liquidity ratios? There's a current ratio, for example, which is from my current assets and my current liabilities, how much coverage do I have basically to be able to cover my current liabilities? So for example, if I've got current assets, now what are current assets? It's any asset that I have that I can turn over very quickly into cash. It could be cash itself. Okay. And your current liabilities is any liabilities that's due in a short period of time. It's not, I need to pay back this loan in the next 2 years or 5 years. It's what do I need to pay soon? Now that's your current ratio. And so if I've got 100 Rand in my bank account and my current liabilities is 50 Rand, well, then I've got a current ratio of 2:1. It means I've got more than sufficient coverage in my current assets, my bank account, or in my inventory to be able to meet my current liabilities. You also get a ratio called, and we're going to go into some of these in a little bit more detail later. We're just going through the definitions. We've got a quick ratio, which is what are my current assets less my inventories, and again, divided by my current liabilities. And why is it less inventories? It's because it's quick access to cash. What can I get access to cash very quickly? And inventories is not always quick access to cash because you've got to sell that inventory, you've got to attract customers. And so basically, this is another indicator as to if I needed to pay my current liabilities immediately, do I have enough reserves without having to go in and make sales to be able to cover that? And that's your quick ratio. Those you get from your balance sheet or your statement of financial position. Now, from your statement of comprehensive income or your income statement, there are a few ratios, but the most important ones is your GP margin or your gross profit margin. It's basically how much after my cost of goods sold or my cost of sale, how much is my gross profit and what is that in relation to my revenue? I'll give you examples for companies that are in the fast-moving consumer goods, FMCG, the likes of ShopRite, Woolworths, Pick n Pay. Their gross margin is generally lower because they buy goods and they sell goods. They don't add in some instances, it's a very high markup. And so their GP margin or their gross profit margin is quite low. But in other industries, in manufacturing, your GP margins can be up to 40, 50, 60%. And so that's an important metric. And lastly, your net profit margin is the bottom line after all my expenses, what's sometimes called EBITDA, or usually called EBITDA, which stands for earnings before interest, taxation, depreciation, and amortization. It's basically how much is left after I've paid all of my expenses except for my interest and my tax. And that's important. Now, when looking at any of these ratios, whilst the ratio itself can give you an indication of health. So for example, a current ratio of 0.2, which means that for every 10 Rand of liabilities I've only got 2 Rand of current assets, can tell you that there's some strain in the business. But more importantly is how this changes over a period of time. What does this look like year on year? And when we look at our example a little bit later, we'll go over some of that. Then importantly, particularly important from a credit perspective, is what are my leverage ratios, i.e., what are my lending ratios? So what is the debt to equity? What's the total debt that this business owns versus the equity that is in the business? And if that's very high debt to equity, we call that a highly geared business. And that's not necessarily a good thing, because it means they've already taken on more debt than they probably should have. And another important ratio is the interest coverage ratio. Basically, when you borrow funds, particularly loans from banks or credit overdraft facilities, you don't necessarily need to always pay back the capital on that, but you at the very least need to pay the interest. And is there enough in this company to at least cover the interest and also to make some capital payments? That is some of the leverage ratios that we'll go through. So let's recap quickly in terms of the definitions. 3 different types of financial statements. Statement of financial position, historically called the balance sheet, which is a snapshot at a point in time, usually at the end of the financial year. Income statement, or called the statement of comprehensive income, and that is your performance over a period. And again, that is usually over the financial year, but it can be broken down into smaller periods, quarterly, half yearly, etc. And your cash flow statement is how is cash flowing in and out. And from those statements, we're able to calculate some of these ratios which I've spoken about. Okay, so how do we assess affordability? Well, there's various ways, and we use these financial statements in addition to others. So what we're going to be covering today is just on the financial statements. We're not going to be talking about surety. We're not going to be talking about any of that. It's just from the financial statements. So how do we evaluate affordability? Well, on your income statement, consistent revenue growth or consistent stabilization of revenue, that is a good sign. And especially if a business is growing 5 or 6%. I mean, we've seen I'm just looking at the Woolworths, Pick n Pay, and ShopRite financials, and each of those seem to have grown on revenue between 6 and 8%. That is good. You want to see consistent revenue growth. This company is selling more than they did in previous years. That's a good sign. Second good sign is stability of their profit margins, especially that GP margin. Is it stable? You know, has the company this year, maybe they had a 20% GP margin and next year it's 21%, that's good. But if you see a company that's got a 20% GP margin and at the next year it's 5%, well, then you should be questioning what's happened in this business that their margins have changed so considerably. Cash flow considerations, you want to see, are they generating enough cash in their business? Why is that important? It's because if you're going to be granting them credit, they need to pay you. How do they pay you? Well, they've got to take whatever goods or services that you provided to them, and mostly goods, they've got to sell it, and they've got to generate cash in their business, and that cash they would use to pay their short-term and long-term liabilities. And you, if you've given them credit, you would be a current liability in their world. Okay. And then a second good indicator is, do they have adequate free cash flow for reinvestment? What kind of reinvestment? This could be reinvestment in property, plant, or equipment. You know, you don't want to be going to the same store that you've been shopping at for the last 30 years and they haven't upgraded, they haven't changed their lights, they haven't changed their floors, they haven't upgraded their equipment. And that's what you also want to see in the financials, that there's adequate cash flow for reinvestment, or that the balance sheet, when we look at it later, is moving in a way that shows that they're reinvesting into their business. And lastly, last but not least, I would say, is debt levels. Do they have a manageable debt load relative to income? Now, if they owe 10 million Rand, but for the entire year, they're only making 4 million Rand of gross profit, well, then that's the problem in a business that you need to take very seriously before you give them even more credit. And then lastly, as we've spoken about, it's adequate interest coverage. So these are some of the things that you would look for when you are assessing and evaluating the affordability. Similarly, in our personal lives, if you go to you want to buy a house or you want to buy a car, you go to the bank and you provide them with your 3 months bank statements, you provide them with your pay slip. They look and they see, does the income match what's on the pay slip? Firstly, yes. Are the expenses, how do the expenses relate to that income? Is there free cash left afterwards that they can use, that you can use as an individual to pay that debt that you're going to be taking? And it's a very similar thing that you would do in business, just with different risks and different rules. So what are some of the risk factors? Well, we've spoken a little earlier about them. One risk factor is, when you're looking at the balance sheet, is liquidity risks. So they've got low current or quick ratios. And when we talk about liquidity, we mean free cash flow. They do not have sufficient liquidity or cash flow to be able to satisfy their short-term debt. For example, I've got 100 Rand in my bank account. I've got to pay 200 Rand tomorrow to a debtor that I owe money. I don't have enough to satisfy that debt. I've got a liquidity issue. I've got a cash flow issue. Solvency risks, very important, because there's a difference between a customer of yours paying you late or not being able to pay you on time versus them not being able to pay you at all. And your solvency risk, they've got a high debt to equity ratio. They owe, like I mentioned in the example earlier on, they owe 10 million Rand, but they're only making 4 million Rand gross profit a year. It's very clear that if that 10 million Rand has to be repaid in a short period of time, that they're not going to be able to pay that. That's a big risk to your business, especially when extending even more credit than what you have currently extended to them. There's operational risks as well, right? Volatile revenue and expenses, big jumps in revenue or big drops in revenue and big jumps in expenses, or negative trends in profitability. A company that is required to discount much larger than they have had last year could affect their GP margins, and therefore that is something that you could also look at. And of course, there's external risks, market conditions. And luckily in South Africa, the year has started off quite well. The Rand to the dollar is just over 16 Rand. And we've got low, I think our CPI inflation for the year last year was in the 3.6%. So we've got good market conditions for growing businesses, but also the regulatory environment. This is in stark contrast to what we saw, for example, during COVID. And during COVID, we saw revenues plummet. Restaurants closed down because they weren't allowed to trade. We know the liquor industry, the tobacco industry took a big knock as well. And we've seen now the recovery. I just read an article last week that they say that the 2025 and 2026 year we're seeing that we're going back to pre-COVID levels, and we're even exceeding those levels. So, for example, that is an external risk that you also have to bear in mind. Okay. And so now that we've taken everything that we've learned, we understand what the important financial statements are. Balance sheet, it's the income statement, it's your cash flows. We understand what are the important things that we need to look out for in these. It's your ratios, it's your profitability, it's how the business trend is looking. Now we're going to walk through a couple of examples of financial statements, and we're going to try to pick out what are some of the risks, what are some of the issues that we can identify in them. So if you bear with me a second, I'm going to stop sharing. Now, what I usually do is I usually pick on the FMCG giants. I usually pick on the likes of ShopRite and Pick n Pay and Woolworths. And we all know that Pick n Pay a good couple of years ago, they went through a bit of a tough time financially, and they seem to have started to come out at the back of that. So I've decided for this session, I'm going to pick on someone else. And I've looked at the financials that all of us would know this company or should know this company, Tongaat Hulett, massive company in the sugar industry that went into business rescue a good couple of years ago. And so I decided to go and bring out the latest financials, which, believe it or not, is financials from 2021, for us to be able to work through and for us to understand Well, why is it that this company went into business rescue? What were the signs that we could have picked up? And how can we use that as an example when going forward? But before I jump into that, I always go back to Martin and I ask Martin if there's anything that he needs to add. Martin's always always pulls me right on track when I've gone a little astray. Martin, anything to add on your side?
No, not at this moment in time. Thank you for the opportunity, Rahil. I think doing a sterling job. Thank you.
Thanks, Martin. Okay, so let's look at the financial statements of Tongaat Hulett. Like I said, it's from 2021. We're going to zoom in a little bit. This is, as I said, the income statement, or as it's now called, the statement of profit or loss and other comprehensive income. And we're going to zoom in here and let's look at this in a little bit more detail. So on the left-hand side, we've got the group, and on the right-hand side, we've got the company. And so, as you would know, is a number of companies would make up the group, and we're going to look at this together. So this is 2020 on the right-hand side and 2021 next to it. So what's the very first thing that I see? The very first thing that I see is revenue doesn't look too bad. I mean, from a company perspective, revenue of this is 6 billion versus 6.2 billion. It's actually looking better. It's gone up 200 million, right? That and during COVID, nothing looks too strange there. However, when we look at the GP, the gross profit, you can see the gross profit was 490 million in 2020 versus 225 million in 2021. That's less than half the GP. And now that's the first sign that I look at that says, I've made almost 200 million rand more in sales, but I've got 265 million rand less in gross profit. That is amber flag number one. So a company doesn't fail because revenue falls first. It starts to fail when margins collapse. And I mean, we can see that this is quite a big drop in the margin. Even though top line revenue looks great, the margins don't look so great. So that's the first thing. The second thing is that I would look at is I would see that it's the second year in a row that this company has made a loss. They've made a 330 million rand loss in 2020 and a 325 million rand loss in 2021. So even though the group made some profits, 3 billion and 1.8 billion respectively, the company itself was not in a good state. So 655 million rand worth of losses in 2 consecutive years, which is roughly 10% of their revenue in any year, is quite significant. That's the second thing that I would notice. And so this is on the income statements.
Yeah, Rahil, just hold it there for a minute.
Sure.
If I look at this, something that jumps out is you've got the revenue. So you see that I'm talking about the group revenue. They made revenue of 15.3 billion in 2020. And the next year, the revenue went down. But the observation I make, to make that revenue, it cost them 8.5 billion in 2020. However, they made less revenue and it cost them 10.6 billion to make that revenue. So something, although the revenue went down, the cost to make that revenue went up. And that makes that gap where your profit comes from even smaller. And that, to me, is already a concern. So if that also happens over a period of time, I would be very concerned.
Absolutely, Martin. Because remember, the way that you pay your liabilities is by operating activities. As you run your business and your business generates cash and your business maintains profits, you can then satisfy your debts and satisfy your obligations. But in this case, we can see that there was a clear, right to the top line, there was an issue in which there was a drop in GP and a subsequent drop in, consequent year that there was a negative operating loss. Okay. And so when you look at finance costs as well, I mean, look at their finance costs. You can see it in this line. Just on the company, 1.1 billion rand in finance costs, right? That is about 20%, just under 20% of what their total revenue in that year is. And the following year, it was 976 million rand. So over 2 years, they've spent over 2 billion rand in finance costs. And this is a company that has not made a profit in those 2 years. That is now not just an amber flag, that is a massive red flag for me in terms of going and extending even further credit to them. And on top of it all, interestingly,
almost borrow money to pay your existing debt.
Absolutely. And on top of it all, the dividend income, okay, the dividend income went up. This is not dividends paid out. So when you look at the loss before taxation, you see that it has, in 2 years, they've made losses. So 1.2 billion and a 431 million, which looks a lot better because of the high dividend income that they received from their investment activities. So that's the first thing, based on the financials that I would look at. Okay. Moving ahead, there's other things that we can look at in the financials. We can look at things such as like the hyperinflation losses from Zimbabwe that is further down here. We can look at the earnings per share, etc. But those are really the main things that I wanted to point out. When we look at the financial statement, the balance sheet, the statement of financial position, and this is where it gets really, really interesting, is the very first thing to look at is their equity. So if you look at equity, their total equity is actually negative. Okay. Negative equity. Martin, do you want to tell everyone what negative equity means? I think we've lost Martin.
You don't have anything. My network is very poor, yeah, Martin. Sorry, Rahil.
No problem, Martin. I'll take over while you sort that out. Negative equity is you're technically insolvent, okay? And you heavily leveraged, which we're going to get to now. So their total equity, you can see their total equity was negative 6.2 billion in the previous financial year and negative 3 billion in the current financial year. And that's because of those accumulated losses that they've kept bringing forward. So that is a red flag in itself, okay? The second that you would see is when we look at their liabilities is their borrowings is very high. It's 11 billion. And even though it did reduce a lot in the current liabilities, it was 6 billion. And so their current liabilities are still way too large. Now, let's go back to our current ratio. Remember, what was our current ratio? Our current ratio said current liabilities, current assets to current liabilities. Well, let's go look at their current assets. As their current assets in this business is 4 billion in the previous financial year, and then it was 2 billion. And their current liabilities was 13 billion versus 7.7 billion. So which means for every 4 rand or 3.5 rand of liability, they only have 1 rand worth of current asset. And that is a massive red flag. And anyone who looked at this would be concerned to see that this business cannot satisfy their short-term debts. Firstly, they do not have the cash to satisfy their short-term liabilities. Secondly, they're not even generating enough cash to get them out of the squeeze. And, it's no surprise that a business like this, based on the financials, that they've gone into business rescue. What are other things for us to look at? Well, let's just go and look at a few more things. As you'll see, then their cash, I was looking at this earlier, their cash basically also reduced quite a bit. So cash and cash equivalents at the end of 2020 was 762 million. And at the end of 2021, 177 million. That is almost 600 million rand worth of cash and cash equivalents that had disappeared from the previous year. Obviously, in trying to keep this business afloat, they burned through a lot of their cash reserves. Okay. And we'll be able to see that quite clearly in the cash flow statement as well.
And plants and equipment.
Great question, Martin. Yeah. So, their total asset base reduced from 7.9 billion to 5 billion, which means that 2.9 billion, almost 3 billion has disappeared from their asset base. Now, where did that disappear from? Well, interestingly, almost 1 billion from their current non-current assets. Okay. and which is mostly from the deferred tax assets that they had. But a large portion of that was from, you see, the asset classified as held for sale. They sold one of their assets, and that's what made, that's where some of the cash was generated, but also why the assets reduced from 7.9 billion to 5 billion. Okay. So let's look at the cash flow statement as well. Second, let me find it. Here's a summary of cash flows. Now, cash generated by operations, they generated in 2020 354 million rand in cash. And in 2021, they used 267 million rand in cash. So overall, that's where that 600 million went to that we spoke of earlier. It was a positive 331 million in 2020 and a negative 326 million. And that is your 600 million swing. They were burning up that cash in their operations. And that is where a lot of that cash and that current assets got eaten up. Okay. They did receive a large amount of dividends, which we saw earlier on in the income statement, which makes this look better than it was. And that is why you'd see the net cash from investing activities looks great. I mean, 816 million in 2020 versus 5.5 billion. But again, you see that's from proceeds on disposal of discontinued operations. They're selling off assets in the business. And when a business starts doing that, it's one of two reasons. One, there's a legitimate reason for selling off assets. You don't require it anymore. The strategic direction of your business has changed. Those could be examples. But that's always something for you to go and look at. Why are they disposing of assets? What's the reason for it? Is it to reinvest in newer assets? So selling off an old building, or for example, to go and invest into new premises, that's a great investment. But selling off assets and not replacing those assets, you always have to ask yourself, why is that happening? And so, interestingly, and not everyone would look at it, there was, if you scroll all the way to the top, in your financial statements, there is an audit finding. And the director's report, this is done by the directors, you would see under going concern, it says the board has satisfied itself that the company and group will continue as a going concern for the year ahead, noting the existence of a material uncertainty in relation to the success of various debt restructure initiatives. So even though they start this line positive, they satisfied itself that the company will continue, they are raising the risk of the debt restructure initiatives. And as part of the going concern, the board considered the ability of the group to achieve its debt reduction plan, which is very important. Now, interestingly, if we go down to the audit finding from the auditor, in this case was Deloitte. Let's go and find the audit finding. Here's the auditor's report. Okay, there we go. Material uncertainty relating to going concern. We draw attention to the going concern note included in the basis of preparation, which indicate that the company's group consolidated current liabilities exceeds its consolidated current assets by 2.7 billion rand, and the company's current liabilities exceed its current assets by 5.7 billion. These notes disclose that the group's South African debt has been refinanced with the new repayment milestones that need to be met within 12 months. Okay, and this condition indicates that a material uncertainty exists that may cast significant doubt on the group and company's ability to continue as a going concern. Our opinion is not modified in this respect. And therein, for me, as an accountant looking at these financials, would have been the final nail in the coffin, and why I would not have given any more credit to this organization. Okay. So, in a nutshell, what can financials do? Well, when you look at financials, they're going to give you key insights in the business. When reviewing financials, there's multiple financials that you can look at. You can look at, but try always to get the latest signed audited financials. Companies will provide you with management accounts, and any of us that are accountants know how much management accounts can vary from the actual financials. But if you're looking at the audited financials and they've been audited by a reputable or by a registered auditor, then you know you can place reliance on the financial statements. And what are the most important things to look out for? Go and look at those 3 different financial statements. Go and look at the income statement. Go and understand what's happening in that business from a revenue perspective, from a gross profit perspective, from an operating profit perspective. Go and understand how the business is doing on the balance sheet at the end of the year as a snapshot. Do they have enough current assets to satisfy their current liabilities? How is the business doing? Are they reinvesting? Are they highly geared? Are they a business that has got negative equity and are technically insolvent? These are the things that you can look out for in financials that will give you an understanding of whether that business is a risk to your organization or not. And lastly, go and see where they get their cash from. I've seen many financials where companies have got great cash. And let's look at another example. Just bear with me a second while I pull this up. I actually pulled up the financials of ShopRite to have a look at as well. And this is an organization we know that the ShopRite group has been doing really well. And this is the latest financials. And when we look at comprehensive income, you see, look at this business, 237 billion rand to 256 billion rand. Okay, that's 20 billion rand increase. Their GP has gone up from 55 billion to 61 billion. Their trading profit has gone from 12.8 billion to just under 15 billion. Operating profits also gone up. When you look at their balance sheet, their non-current assets has gone up 10 billion. And you can see that that is mostly right-to-use assets, but they're also investing in their property, plant, and equipment, going up from 19.6 billion to 22.5 billion. And their current assets have also gone up from 50 billion to 52 billion. And when you look at the equity, very strong equity, 27 billion in the previous financial year versus 30 billion currently. And even their current liabilities have gone up in, maybe a little bit, non-current liabilities have gone up in the same ratio as the current assets have. And their current liabilities have also gone up in the same ratio as their current assets. This on paper is a business that is, you can see, strong revenue growth, strong GPs, stable GPs, strong operating profits, strong balance sheet. This is a business that we all know that the ShopRite Group is doing quite well. And this is a business that, based on their financials, you can see it's, it is a business that's doing quite well. So, in stark contrast to the financials that we saw of Tongaat Hewlett, which, we saw was not a business that was doing quite well, that was doing well for quite a period of time. And hence why in 2023, they applied for business rescue, and they've since been in business rescue. And I haven't seen the updated financials. I'd be very keen to get my hands on them to see how the business rescue practitioner has been able to turn that business around, if they have been able to.
Yeah, we have a question in us every Thursday from 10 to 11.